This research right here shows us just how difficult it is to beat a market cap weighted index. Check it out. 92.43% of all large cap funds underperformed. In other words, they did not outperform, they did not beat the S&P 500 over a 15-year period. 95.13% of all mid-cap funds underperformed the S&P Mid-Cap 400, and well, small caps only did worse. 97.7% of all small cap funds underperformed the S&P Small Cap 600, a market cap weighted index, over this 15-year period. So why is it so difficult to beat the market? What's going on here? Well, simply put, market returns are typically highly concentrated. In other words, a very small pool of stocks generates most of the returns in the market. And a professor at ASU recently did some research on this and published this paper right here, which I'll link to below: Wealth Creation in the U.S. Public Stock Markets, 1926 to 2019. And with this paper, he actually published an infographic, which is what we're going to look at. This summarizes, I think, the key findings of it very nicely. So let's take a look at things. And first, I guess we'll start with the parameters. For the infographic, the paper has been updated, but the infographic is 1926 to 2017. The paper has now been updated to reflect 2018 and 2019, as we can see there. But going back to the infographic, the key principles are still the same. Nothing has substantially changed, or nothing has materially changed, as we would say in the accounting world. 58% of stocks failed to beat Treasury bill returns over their life. So over half of the stocks did not outperform what is basically a cash equivalent, short-term treasuries. 38% of stocks beat Treasury bill returns by just moderate amounts. 4%, or just over 4%, of stocks are responsible for boosting the market's overall returns higher than those on Treasury bills. Right, and it's all summarized nicely, I think, here in this little sentence, which we'll read. Besim Binder, I'm sure I'm butchering that last name. So Besim Binder found that all of the $35 trillion in wealth that stocks created over and above Treasury bill returns between 1926 and 2016 could be attributed to just 1,092 companies, or 4.3% of the nearly 26,000 stocks that have been traded in the markets. More than half of the 35 trillion came from just 90 companies, or less than 1/3 of 1%. So if you are a stock picker, I mean, your work is really cut out to identify that small pool of stocks out of a very large pool. And if we look at this chart right here, it just shows the amount of wealth that the company has created in the years publicly traded since 1926. Now, when I first looked at this, I saw Amazon up here and I'm going, what the hell is wrong? Amazon in the 75 to 80-year-old range? That's not right. But this is actually more of just a sticker kind of plopped on the graph, whereas Amazon's actual data point is over here at 20 years. So I'm guessing Amazon IPO'd in 1997. I thought they IPO'd a little bit later, but I guess it would have been 1997. But anyways, that's irrelevant. We can see the companies that have contributed the most to wealth as measured in terms of equity, U.S. equities. Apple being up there. ExxonMobil up there is a real interesting one because in the last few years, they've really declined in market cap. Or I shouldn't say they've declined. I don't know if they've declined in market cap, but they haven't gone up with the rest of the pack. I think maybe 10 years ago, they were like a top 3 company by market cap, maybe even the largest. Right now, I know as of recording this in 2022, I don't believe that they are in, actually, no, they're not in the top 10. I think they're 22 or 23 on the list of largest U.S. companies by market cap weighting. So yeah, then we got a bunch of companies over here I really don't know much about. We got your classic blue chip, Johnson & Johnson, Procter & Gamble, IBM, GE. I don't know if GE is still considered a blue chip anymore. They had their heyday in the late 90s, early 2000s, and well, that was their heyday, and that day ain't today. So anyways, just some interesting data here to look at. The big point is, if you are a stock picker, if you're an active stock selector or an active fund manager, you have to not only identify the narrow companies, identify from the narrow pool the companies, or identify from the large pool the narrow pool of companies that are going to have growth, but you also have to know when to exit them and to get into other companies that are going to grow to keep your outperformance up. So yeah, I will link to this paper below this video. And then I wanted to also show this chart right here, which Ben Carlson shared in this blog post. Ben Carlson publishes an awesome blog, A Wealth of Common Sense, and also does a podcast called Animal Spirits. I was going to call it a video log, a vlog. A vlog, but yeah, you can watch it as a vlog on YouTube, but you can also listen to it on a podcast player. Anyways, this chart right here shows the returns of the 5 largest stocks in the S&P 500 year-to-date 2020, and yeah, end of December 19 to year-to-date 2020. So the first 3 quarters of 2020 is when this chart was based on. It was originally published by Goldman Sachs, so not original to Ben Carlson. But the 5 largest stocks have returned 35% year-to-date. The other 495 stocks, I'm guessing market cap weighted, have declined by 5%. So you can see the concentration in returns there in 2020. Now, interestingly to point out here, this was the 5 largest stocks. And that is not always the case. I don't know for sure, but I'm going to go ahead and say confidently that's not always the case. Over the last few years, market cap weighting has really grown. The inflows to market cap weighted funds are growing rapidly. So the largest companies are subsequently growing rapidly with that large inflow, and maybe some other factors, but I think that you'd be naive to say that the large inflow to market cap weighted funds is not having a substantial impact on the performance of those large companies. I would say maybe the top 5 largest companies of the S&P 500 comprise about 18 to 20% of it. So they keep growing as more people pour more money into the S&P 500, and over the last few years, we've certainly seen that be reflected, and I believe that's why we're seeing the largest companies outperforming. But over time, it's not necessarily going to be the 5 largest companies that are having these outsized returns. I mean, it could be, 5 companies in a weird niche, the 5 most value companies, right? There's no real rule, or there is no rule at all that says it has to be the 5 largest companies. And there's no rule that says which companies they will be. Otherwise, it would be real easy to beat the market, wouldn't it, right? If we had that definitive rule. So yeah, that is why it is so difficult to beat the market, in my opinion, largely because the returns are so concentrated. To be a stock picker or a fund manager and actively beat the market, you have to identify a very narrow pool of stocks, just to actually beat the market. Whereas, well, if you invest in the whole market, you get the market cap weighted returns and you don't have the risk of underperforming the market, and you're statistically more likely to outperform the people that are trying to beat you. Anyways, guys, that's a wrap on this video. I'm signing off.